Hi traders, Gavin McMaster here from Options Trading IQ, and today I'm doing a video collaboration with Barchart, and we're going to be looking at covered calls. Just before we start, a quick disclaimer that everything discussed is for educational purposes only, is general in nature and does not take into account your personal circumstances. All right, so a covered call is an options trading strategy where an investor sells call options on a stock they already own. For selling the call, the investor receives a premium, which is theirs to keep. In exchange, they give the call buyer the right to buy their shares at the strike price on or before the expiration date. So why do we sell covered calls? Well, they can provide a way to generate extra income from a stock holding. They can provide a small buffer in the event of a drop in the stock price. They can be used to sell shares for a higher price. Let's look at how to sell covered calls. Firstly, we want to identify a stock you already own or are interested in owning. Select an expiration date and strike price for the call option you plan to sell. Calculate the potential return and risk of the covered call trade. Execute the trade and monitor its progress. Let's look at an example. Let's assume XYZ stock is trading at $100. You own the stock and don't think it's going much higher. You want to increase the yield from the stock and decide to sell a call option with a strike price of 100. You would only sell this call if you are happy to sell your shares at that price. The buyer of the option takes the other side of your trade and is bullish on the stock. They think it's going above 100 and perhaps beyond. For the right to buy the stock for $100, the option buyer pays you a premium of $5. Let's look at a couple of different scenarios. Let's say the stock goes down to $85. The buyer of the option will walk away and lose 100% of his $5 investment. You will still own the stock, but are sitting on a loss of $10. A $10 loss is better than the $15 loss you would have if you hadn't sold the call option. Let's say the stock stays exactly where it is at 100. The buyer of the option will walk away and again lose 100% of his $5 investment. In theory, he could exercise the option if he wants to own the shares, but it's easier to just buy them directly in the market. Note that most brokers will automatically exercise an option if it is 1 cent in the money. So if the stock closes at $100.01, the option would be automatically exercised. The break-even price for the option buyer is $105. He needs the stock to go up above 105 for him to make a profit because he's buying the shares at 100 and he's paid $5 for the premium as well. So 105 is his break-even price. And for the option seller, $95 is the break-even price because he's bought the shares or owns the shares with a cost basis of 100. He receives the $5 in premium. That reduces his cost basis down to 95. So in the scenario of the stock staying at 100, you as the covered call seller made a profit equal to the premium received. The stock stayed exactly where it is. You're zero on the stock position, but you've made a $5 profit from selling the call option. What about if the stock goes to $115? If the stock goes to $115, both investors are happy, although you're a bit disappointed you didn't just hold the shares outright. You still make a $5 profit, which is a 5% return, but you've left another $10 on the table. So in this scenario, the person who bought the call option has done better because he's received a higher profit. And you can see that here in the table, the option buyer's profit and the covered call traders' profit for various stock prices. Market volatility is currently at the lowest levels we've seen in the last few years. Does that mean we should not sell covered calls? Low volatility means low premiums, but it also means stocks are stable and generally rising. That is good for covered call traders. I would argue this is a fantastic time for trading covered calls. Let's look at some frequently asked questions about covered call trading. How do I select the strike price of my covered call? Well, if you're really bullish on the stock and you want to just generate a little bit of extra income, you'd choose a call option that's quite far out of the money, maybe like a 10 or a 15 delta. If you're more neutral on the stock and you think it might drop or stay fairly flat, you might choose an at the money option to sell that covered call. So something like a 45 delta. If you're kind of in between, you might choose a 30 or a 25 delta, something like that, which allows a little bit of capital appreciation and also still generates a pretty nice premium. So it really depends on your goals and your outlook for the stock, whether you want to achieve, allow for more capital gains or if you're looking for more income. What happens if the stock price rises above the strike price? So if that happens and we get towards expiration, at some point, that call option is going to get exercised by the call option buyer. And what will happen is your 100 shares of stock will be removed, be sold at the strike price, and the position will go flat. Okay, so you'll have no more position. Can I close the position before expiration? Yes, you can do that. You can close the entire position. So you could sell the 100 shares and buy back the covered call, and that would leave you flat. Or if you want to hold on to the shares, you can buy back the call option and just continue holding the shares. Now, scenarios where you might do that is if the stock's rallied up and it looks like you might get assigned and your shares get taken away from you, but you still want to hold on to the shares, you might buy that the call option piece back, maybe for a small loss, but you still get to hold on to your shares. Another scenario might be if the stock has dropped a little bit and the call option that you've sold has very little value, you might buy that back and potentially sell a new call or wait for the stock to rally back up before selling another call. So yes, you can close either part of the position or the whole position before expiration. How do I manage risk in covered call trading? So it's really like any long strategy where you want to pick quality companies. So one way to do it is stable blue chip companies. Generally, they're going to be pretty low volatility. They're not going to move around too much. They're not going to suffer massive declines. Another thing to consider is trading ETFs. So there's no stock specific risk and you don't have the risk of a stock dropping 10, 15% on earnings, which happens 4 times a year. The other thing you can do is consider a stop loss. For example, if you buy the stock and sell the call, and then the stock drops, say, 8 to 10%, you might look to get stopped out at that point. So that's a couple of ideas for you in terms of managing risk. Let's take a look at Barchart's covered call screener and analyze the results. So here's our covered call screener, and you can see we've got APLD stock as the number 1 on the screener for today. The price of the stock is $9.91, and it's looking at selling a $12 call option, so the 12 strike, which is quite far out of the money. Expiration date in August. For selling that call option, you'd receive $125 in premium. If the stock stays flat and the call expires worthless, that's a 14.43% return. If it goes up through the strike price and gets called away at 12, that's a 38.6% return, which is about 312% annualized. Now that's a very high return. Typically what I do is I'm going to avoid some of these more volatile stocks, which is why we're seeing such high returns. So to avoid that, I'll come into the filters and I'll filter for some more stable blue chip type stocks. So here's a screener that I like to use. I like to set the overall opinion rating above 50%. So I want to choose stocks that have got a buy rating. I want a beta between 0 and 1. So again, that's trying to filter out some of those really high volatile stocks. I want a market cap above 40 billion. So eliminating anything that's really small cap. I'm looking at mainly monthly expirations, and the other settings are all pretty standard. Option volume of at least 20 for the day and open interest of 100. And let's take a look at those results. If we sort by annualized return, we're still seeing some really big returns on stocks like Snowflake, Baidu, even Intel. That's because they're quite far out of the money. So maybe I'll sort for ones that are more at the money. So for example, here's a good one on McDonald's, nice quality blue chip company. Could buy the stock for $294.84 and sell the at the money call option. So this is a real high income generating trade, whereas there's not much potential for capital gain because we're selling the strike price right above where the stock is. For selling that call option, we'd receive $325 in premium, and that's a 1.1% return in about 2 and a bit weeks. If it goes up through the strike price, a 1.2% return, which is 25% annualized. So that's a pretty good scenario there. Let's try and filter this down just a little bit more, and I'll add one more thing, which is call volume, total call volume. And this is for the stock for the day. I want to see total call volume above, let's say 3,000. And that brings our results down quite a bit and gives us some more options. I'm going to get rid of SPY as well. Just deselect ETFs there. There we go. So now we're getting some more stocks. Merck is a good one, quite low volatility. Home Depot, there's a nice one there. Potential 43% return if it gets up above 312 by July 21. Visa, another really good stock at the moment. Slight difference here where we're looking at a September call option and a July call option with the same strike price. You can see there the return is quite a bit lower because it's taking us a longer period of time to get that return. So the annualized return is lower, but the actual premium is a lot higher at 760. So slight differences in strategies there. For me, I tend to prefer going a little bit longer term. So I'd lean towards something like this on the Visa trade and get that nice 3% return in about 2 and a bit months. And if it goes up through the strike price, which is only 0.85% above where the stock's trading now, that's nearly a 21% annualized return. Hope you enjoyed the video. Don't forget to check out Barchart Excel, barchart.com/Excel, free 14-day trial and no credit card required. Highly recommend it. Have a great day, and I'll talk to you soon.